Hello everyone, I'm Shekhar from Momentum Lab. In today's video, I'm going to clear an important misconception that many people have, that when they see the backtested results of any strategy, they assume that these results are going to be replicated in the future as is. But most often, it is not the case. We might be seeing results sometimes better than what we have seen in the backtest, and sometimes worse than what we have seen in the backtest. If you give sufficient time, then our results might be somewhere closer to what we have envisaged in the backtest, but there can be a lot of variation. Now, many of you might have already seen this diagram. Let's use this diagram to drive home our point on backtesting. Now, imagine all these lines are different possibilities that a particular strategy could have undergone. Think of these as NAVs in the past. Now, of all the possibilities, only one possibility was materialized. This was a backtested strategy or result, which is in the green color. Now, is there a surety that this line is going to continue the same way in the future? No. There can be again multiple possibilities, as you can see in these different green colored lines. But not all paths have equal probability. Some paths have a higher probability of occurring. Now, what we are interested in seeing is, can we get a reasonable estimate of, let's say, 80% probability that this is the range of paths that a backtested strategy can take in future. Now, if we have that range, then we can tone down our expectations that this is the range of possibilities that this backtested strategy can have in our future. Now, when we have that range expectation, then that is much better than having a simplistic absolute expectation. Most people, when they do a backtest, let's say a backtest says that it will give you 18% returns with 20% volatility and 30% drawdown, they get fixated with that number 18, 20, and 30. And whatever is different from those numbers, they can't digest that. Why am I getting the different numbers when I did a backtest and I'm supposed to get 18%? And if you're getting, let's say, less than 18%, you would be taken aback that this backtest is not worth it, or this strategy itself is not good. But if we think in probabilistic terms, then we might be at peace with whatever we have seen in the past and what could have happened, what can happen in the future, because the future will not exactly replicate the same way as what has happened in the past. Now, how do we do that in real? So we can use Monte Carlo simulation to do this exercise and get a realistic expectation of probabilities or ranges that we can expect from a backtested result in future. So I'll go back to our backtesting strategy and take that as an example to run a Monte Carlo simulation and show how can we interpret the results. So the backtesting strategy that I chose is equal allocation among different factors, that is momentum, value, low vol, quality, and alpha. And see, by equally allocating among these five, 20% each, how are the results going to look like? And when we run a Monte Carlo simulation on top of these results, how will those results look like? When we ran this backtest, we saw that the results are like this, that the strategy, which is shown here, let me zoom in a bit. Now, these are all individual factors: momentum, value, quality, alpha, low vol. These are the different parameters that we have calculated. That is, what is the CAGR that it gave between 2006 to 2024? What is the 3-year rolling return? What is 5-year rolling return, 7-year rolling return, annualized volatility, max drawdown? Now, let's focus on the strategy, which is nothing but the equal allocation of all these factors. So these are the results that you see. Now, just remember these numbers: CAGR of 20.47, 3-year rolling return of 17.5, 5-year rolling return of 16.75, and a 7-year rolling return of 16.5. So nothing less than 16.5 is what we see when we do a backtest and when we run it across rolling periods. These are the numbers. Now, how are we going to do Monte Carlo simulation, and what is the Monte Carlo simulation's logic? Now, to do that, I'll explain with this monthly numbers that I've pulled out. So what you're seeing right now is, in the column C, you see all the month ends, that is 31st August 2006 till we have till 20th August 2024, till when I did this analysis. At the end of every month, we calculate what was the monthly movement of this strategy's NAV. So in the first month, the strategy moved by 9.7%. So if we started with 100 rupees on 1st of August 2006, by end of August 2006, we moved to 109.7. So that's how you can think of these numbers as monthly change. Let me write it down here. Monthly change. Now, every month, the change in NAV is different. Sometimes it is positive, sometimes it is negative, sometimes it is wildly positive, sometimes it is wildly negative. So there's a lot of fluctuation. You can see the fluctuations of the monthly movements here. Now, what we are interested to see is the sequence. in the past, this particular strategy has undergone this sequence, which is unique to it. First, it moved by 9.7, next month, 5.35, and the month after, 4.09, and so on and so forth. Now, what if we change the sequence? Let's bring after 9.7 returns like minus 3.14 in place of 5.35. And in place of 4.09, what if we exchange it with minus 8.48? Now you can imagine there are so many possibilities as we interchange these monthly returns, then so many possibilities can arise. That's what we're trying to do here. When we change a lot of scenarios in the past, then we see that the realities can be different. Now each can be a different reality that could have happened. Now once we see that uh, so many different realities could have happened, and then we'll know if you're able to calculate what is the CAGR for that new reality, what is the rolling returns for that, what is the volatility and drawdown, then we'll get to know the range of outcomes or possibilities that could have happened. Now, how many such different possibilities are there? In total, we have around 217 months of data. So you can think of it as 217 factorial. So that's a mammoth number. Now, we can't obviously do all such calculations with the limited resources that we have. Let's at least model 10,000 different possibilities. And from those 10,000 different possibilities, get some numbers and see what is the median outcome of all those possibilities. What is the 95th percentile? That's the best case scenario. What is the worst case scenario? That is fifth percentile. And what are the median or base case scenarios of, let's say, 25th percentile and 75th percentile? Now, when we know these ranges, the percentile and the outcome of these ranges, then we have a good enough estimate of what can happen in future. So I'll show the Python code that we had run, and I'll be more interested in showing the results or the outputs and how do we infer the insights from this output than the code. There are already a couple of tools available where you can run the Monte Carlo simulations. So more than the input, I mean, if you have your own code, it is better because you can customize, you can add your own logic on top of it, and you can tweak it a bit that suits your style or your requirements. But the most important thing is that there are tools available outside where you can use them to run the Monte Carlo simulations. And in running a Monte Carlo simulations, you basically need two inputs. One input is the mean. The second input is the standard deviation. The mean is the mean of all possible outcomes that you have seen in the backtest, and standard deviation is the standard deviation that you've observed in the backtest. So if you have these two numbers, then your job is done. And it takes usually the Monte Carlo tools that are available on the online platform, they take a normal distribution of the outcomes that would have happened. But instead, I'm not taking the normal distribution. I'm exactly in my code, I'm using the path. So that has happened in the past, and I'm using only these numbers to play out the scenarios, or by interchanging these sequences, what kind of results can happen, and we'll see the results. So there are a couple of things that I've modeled into it. I'll explain one by one. So on the x-axis, you see the number of months. So I've taken 60 months in future to model it. Let's say if we have 217 months of data, right? And what if we randomly pick 60 months from these numbers and see how this NAV would look like after the 60th month. So that's what we show here. And on the y-axis, I've taken a base value of 10 lakh. So let's assume that I'm starting with 10 lakh. And after 60 months, where will the final number lie? So that's why you see all the numbers start from 10. Now, you also see different colors. The red colored line is the scenario of the 95th percentile, meaning there are only 5% of the outcomes above this red colored line. Now, the bottom red color line is the 5th percentile, meaning there are only 5% of the outcomes that are below the 5th color line, this red color line. So basically, this red and this red are the extremes. You can see this as the best case scenario, and this is the worst case scenario. And you can also observe that each line or each path that you see, right, this small tiny blue colored line is one particular path. Now, most of the paths are centered around this black colored line, which is the median. And the thicker or denser blue colored line or blue colored path, it indicates that there are more number of possibilities or outcomes around these ranges. The light colored ones indicate that there are less number of possibilities that are happening at these levels. So you see that the median is a best case scenario of of what can happen at the 50th percentile. Now the green color line, what I've done is, let's assume that if you invest in a fixed deposit, now where can that number lie like? So if your base case scenario if that base case scenario number is above the green colored line, then it means that you have a decent or good enough probability that your investment into strategy is going to beat FD returns. So if the bottom red color line is above the green color line, then it means that you are even if you are underperforming in the strategy, whatever that you have backtested and you've invested in that money, and there is only 5% chance that you might underperform the fixed deposits. Now, if you want to know, even after 60 months, what is the probability that you're going to get negative returns? Yes, you can do that. You can change this green color line and see what is the possibility that you actually might end up getting. So there are certain scenarios where even after 6 months, or sorry, 60 months, we see that we still can end up getting negative returns, but the count is very less. So this way you can visualize what can be the range of outcomes after backtesting has been done and what can we expect. Now, there is every possibility that your backtest might underperform certain thresholds, like even getting positive returns of 0%, beating the FD returns, let's say 6%, beating Nifty, for example, let's say Nifty on average moves by 12%. And we're interested in seeing what is the probability of me beating these threshold numbers. So we've calculated those also. You can see it here. So this particular piece of the code or the output that I want you to focus on. So the probability of achieving 8% CAGR or higher is 90%. So we beating the FD returns, I'd say at 8% is 91%. So that's a good place to start at. And the probability of achieving 10% CAGR is 81%. And the probability of achieving 12% CAGR, let's say this is what Nifty gives, is around 63.6%. And the probability of achieving 14% CAGR is 45.8. As you see that if you have the higher expectation, the probability is decreasing. And the probability of beating the Nifty, which is 12%, is 63.6. So in the backtest, what we have seen, in the backtest, we have seen that all the 3-year rolling returns, 5-year, 7-year rolling returns, CAGR are way above the Nifty returns. But when you do this Monte Carlo simulation, you see that this might not exactly happen in the future. There can be certain cases or scenarios or unlucky investors who might actually end up getting less than Nifty returns. So a backtest is never a foolproof way that this is how exactly it's going to happen. It is a best, I mean, it's the best that we have to backtest, because if you don't backtest, then we have nothing to rely upon. So that's the best starting point that we have. And after that, if you've done a Monte Carlo simulation, then you'll get even better picture. Like what is the probability? Then you'll start to think in the probability terms that yes, my strategy, even though the best of efforts that I've put in, can underperform. Once you have that, then you'll think about how do we improve. I also show how can you improve the odds of improving your strategy, but essentially it gives peace psychologically. Our mind is at peace that yes, whatever best effort that I put in, there can be something that can go wrong, and I might be the unluckiest person. So we at least will choose those strategies where even the unluckiest scenario of the probability of not even achieving the FD returns is lesser. So in that case, then we have at least a decent enough strategy. So you always take a look at this number, probability of achieving 12% CAGR. And if this number is high, then you have a very good strategy. Now I've talked about how do you interpret the results, right? Let's also see another way of looking at this data, that is the distribution of what is the portfolio value that you can get or end up after 60 months. Now, there are different possibilities. There are some possibilities where you can end up getting less than 10 lakhs. So I've pointed the frequency on the y-axis, and on the y-axis you see the frequency. On the x-axis you see the different ranges of portfolio values that you can end up after the 60 months. So it starts from let's say 9 lakhs to almost 36 lakhs. A lucky few might end up getting 35 lakhs. You see that this distribution is right skewed. It is skewed towards the right. That's good. So in case you're lucky, you might end up getting phenomenally high returns or high portfolio value. And in the unlucky scenario, at least you might end up getting where you were starting with. Now, the green color line is the amount of money that you could get by investing in T-bills. And you see that majority of the portfolio values are lying right side towards this green color line, which itself is a good news that this strategy outpaces the fixed deposits comprehensively. And this black colored line is the median, or where does the portfolio of all such different combinations that we have seen, right, in the Monte Carlo, where do they lie in between? So you see somewhere around 18, 18 lakhs is where you can get after 5 years if you invest 10 lakhs in this equi-factor strategy. Roughly around 18 lakhs is where you can expect your portfolio value to be at the end of 5 years. Now I'll talk about the different ways where we can improve the odds of uh, having a tighter range. Now this is a wider range. I mean, even at least by observing this, you can tell that like this is some people might not be comfortable expecting such a high range of outputs after 5 years. We want predictability, a narrower range, so that we are more comfortable. At least, yeah, this is what I'm expecting. If you invest 10 lakhs and you still end up getting FD kind of returns after 5 years, then many of them would be taken aback. Now there are two ways that you can do. What I've done is, first, you also might know this. If you let the time in the market to be higher, so let's say instead of 60 months, if you model it to a higher time frame, then the outcome will be different. So let's see this example. Instead of 60 months, let's say I do 120 months, then the probability outcome is different. And instead of timing with any one single point, if we do a SIP, then again our range would be narrow. So let me show you this example. The blue colored line or the blue colored path is what we see when we invest at any one given point of time in lump sum based on our strategy that we backtested and let it run. And we see the results can be as varying as these. Now, let's say we break that 10 lakhs into incremental equal amounts over this 60-month period, so that by end of these 60 months, all the 10 lakh is deployed. Then you see a more narrower range. And this narrow range also, you see the distribution for the narrow range. The red colored line obviously has a lesser portfolio value than the blue colored line. And you see the green colors. These are the bars of the SIP mode, where there is surety, narrowness, where in the case of lump sum, you see the range is quite big. And also you see that the possibility of you getting a higher returns is in lump sum than in SIP, because the more time that you spend in the market with a significant amount of time, the portfolio values can change, and that can change your fortunes also. If you're doing an SIP, then some amount of money is working full time, some amount of money is working part time, and only when you're fully deployed is when your portfolio starts to actually start to work. So that's what we see in terms of the difference between SIP and lump sum. SIP is a great way where we can improve the odds of narrowing down the possibilities. And if you spend more time in the market, this is the second analysis that I had done, where you give sufficient time, then you see that the possibilities or the outcomes are even better. Now you notice the blue color line when you start with 10 lakhs, even after 120 months or 10 years, there is almost zero possibility of we getting returns less than 10%, less than 10 lakhs. So the worst case is also above 10 lakh. Now, that's also the case with the SIP. The worst case scenario is also never below 10 lakhs. This worst case, I'm not talking about the fifth percentile. This is the worst case. So that's how you can incorporate these learnings into your strategy. Backtesting is not the holy grail. Backtesting is just one part. After backtesting, please do a Monte Carlo simulation to get the range of outcomes. Now, this range of outcomes will give you a possibilities that you can expect. Take the 25th percentile to 75th percentile as the range of possibilities that can happen. And anywhere if you're lying between them, you should that's a happy scenario to be and not fret about that. Why am I not getting the best possible scenario? Always think that you're average and you'll always get the average results. And secondly, the range can be shrunk by instead of doing a lump sum by SIP. Some people are comfortable doing SIP, some people are not. So it's all personal choice. But if you do an SIP way, then you can have a more narrow range of outcome or possibilities. A third thing is if you spend more time in the market and there's a higher probability that you might end up getting better returns. This is our age-old concepts, nothing new. I've just shown it in a visual format. The main takeaway is not the SIP or staying more times in the market. This have already been repeated multiple times in different videos by different people, etc. The main takeaway is the first part of doing Monte Carlo simulation and seeing the range outcome, so that we think in probabilities, not in simple absolute number. Now, I mentioned that there are a couple of tools, right? You can always take a look at this QFINAR, which has this Monte Carlo simulation. You can take a look at it. This is not a financial recommendation in any way. It is just education that I intend to do. And I'm not a SEBI registered advisor or a research analyst. It's all for education and information purposes. I hope this video was helpful for you. Let me know in the comments. Happy to help. Thanks, guys. Have a nice day.